This signal that we just got has appeared 5 other times in the market's recent history. Every time this signal happened, it was followed by a sharp decline in the stock market's performance. They always occurred during an economic recession in the United States. We're seeing plenty of activity in the market, so let's break it down and see where things currently stand and where they are going. Hi, I'm Noah from FXMeridian, and this is the monthly market overview, where we go over the economic changes and take a closer look at the market's potential next moves. Let's get into it. Recently, the US stock market experienced a sharp decline of over 10% due to the chaos ignited by the Trump administration's endless wave of tariffs. Now, the thing with tariffs is, they tend to backfire. Because they are paid by the party receiving them, they hike the prices of imported goods, squeeze consumers, and isolate the country imposing them. This strain on international trade relationships can disrupt supply chains and often sparks retaliation, which lead to over $7 trillion being wiped out in the span of 3 days. This isn't just a dip, but a reality check for investors after the hype-driven rise to all-time highs in January and February. The average American's confidence in the job market today is also collapsing, with consumer expectations of the labor market dropping to levels similar to those all the way back in 2008's financial crisis. You can clearly see a collapse in confidence on the chart over the last few months. Most banks and hedge funds have moved their price targets for 2025. Some investors were predicting a recession to happen in 2026, but the market data that we have before us gives us a much darker outlook for the near future. Based on it, in the first quarter of 2025, we can see warning signs of a bear market, similar to the one in 2008 and 2001. But until we get further confirmation, we are simply moving to a risk-off position. Taking a look back at history, we can clearly see that a drop in consumers' confidence in 2008 and 2001 is followed by the labor markets having just as large of a drop, which in turn signals a recession. The interesting thing this time around in 2025 is that the labor market data is actually not deteriorating, unlike its consumer confidence counterpart. In fact, jobs are actually increasing since the start of the year. And history doesn't always repeat itself, but it does rhyme. Over at FXMeridian, we follow the money, and as such, we've been taking a look at one of the best investors of all time. Warren Buffett's Berkshire Hathaway's holdings are currently sitting on a $335 billion cash pile, waiting for opportunity to strike. If you want to find such positions, then register for a CFD trading account on our website. Now, historically, periods of extreme oversold readings have been followed by relief rallies. For instance, in February 2020, despite the onset of a global pandemic and widespread economic disruptions, the market rose approximately 10% after registering similar oversold indicators. Bond yields support a more positive outlook, with their stability showing an unchanged macroeconomic outlook from the perspective of bond investors. There have been no significant spikes or drops in yields as seen in earlier inflationary or recessionary periods. Market volatility is also being influenced by the economic policy uncertainty due to the change in tariffs. This indicator has reached levels which were last seen during the 2020 pandemic crash. Another market segment often viewed as a leading indicator is the home building sector, which has demonstrated sensitivity to tariff policies as well, particularly those related to imported materials like lumber. Historical patterns show that home builders began underperforming in prior tariff-heavy environments, a trend that preceded broader market downturns. Recent market activity has not shown a marked outperformance in the home building sector, suggesting that tariff-related concerns may still be unresolved. TradingView users posted, "A massive rock has just broken loose and begun its slow, endless tumble down the rugged hillside, lurching and rolling through countless dips and rises, dragging on with no end in sight, its long descent only now starting to unfold." From a historical perspective, spikes in the VYX of this magnitude have often occurred during broader market corrections. These events are commonly analyzed for their potential implications on long-term market behavior and sentiment. A similar pattern was also seen in 2008, shortly before a broader 50% market decline. These historical instances have been referenced in market analysis as indicative of a shift from risk-on to risk-off positioning, where gold tends to be favored over silver amid uncertainty. While such signals are noteworthy, it is important to note that they do not inherently confirm the onset of a recession or further market decline. Historical correlations do not guarantee future outcomes. Recent market conditions have shown signs of elevated volatility and investor unease. At present, there is no broad consensus from banks suggesting a recession is imminent in 2025, although economic policy uncertainty, including tariff-related developments, remains a variable to monitor. Market participants are closely watching these signals in the context of broader economic indicators and sentiment data. Historical precedent suggests that markets do not move in a straight line, even in periods of contraction or panic. That's all for this quarter. If you enjoyed what you saw, you can leave a comment, subscribe, and like the video.